All right, thanks everybody for hopping on, and thank you, Simon, for joining us. Simon's our guest. He is going to be doing us the pleasure of giving us some training, particularly surrounding IULs. Simon has written well over $450,000 worth of business at this point, mostly almost exclusively IULs. Obviously, if you've written any IULs, you guys know that it certainly can take longer for those IULs to get placed, issues, just depending on what it is that's needed. He has written a lot of business in a very, very short space of time. So it's an honor to have you on. It's an honor to have you doing some training today, Simon. So just some topics that are going to be, that would be really great if you wouldn't mind just giving us some coaching on it. I did make you the co-host, so whenever it is that you need to share your screen, you should be able to do so whenever necessary. So a few important topics. Number one, some important points when it comes to structuring an IUL. And understand, guys, we only have about 45 minutes or so worth of time here. So we can't go into all of the nitty gritty detail that that you would normally do when it comes to structuring an IUL. Sometimes it can take a day or two to structure an IUL the best, to go through all the different options and so on and so forth. Okay, but how to structure an IUL, some important points, understanding how to overfund an IUL and why it makes a difference. Red flags. So thinking about whether or not a client is a good fit for an IUL, and key things that you always want to explain to a client when talking about an IUL. So Simon, I'm going to give you the floor since you are the coach today. So without further ado, thank you, Simon.
Hey, thank you very much, Jen, and thank you everyone for coming. This is an opportunity for us to explore everything IUL.
Okay, perfect. So first, the important points that you think about and consider when it comes to structuring an IUL. If you could just take us through what some of those different things are and what you look at. I know that F&G is one of our current favorites right now, but there are a lot of different carriers that we can use. If you want to pull up an example of an illustration or do a test illustration to talk about what it is that you think about when it comes to structuring an IUL, that's great. But in particular, when it comes to structuring an IUL, what are the important things that people should be thinking about?
All right. The first and foremost, the most important thing that should come to your mind when we're structuring an IUL is considering what the client actually wants. I always make sure what I do is that when I get on Zoom with my client or the prospect, I try to get an understanding, complete understanding of what the client wants. And then after getting that complete understanding of what your client wants, obviously you have to do some follow-up or layering of questions to do a thorough financial inventory. And not only financial inventory, I also do financial need analysis. And after doing the financial need analysis, it will lead us to calculating the individual's financial independence number. Those are certain words that we may be able to talk about later, but financial need analysis is just trying to do a financial inventory, a detailed financial inventory that we usually do when we go to home, asking questions of how much the person is making, if this person is working or not, if they have a steady stream of income, what is it that they are able to put aside, and what is it that they are willing to invest in this plan is also very important. But before that, just having a clear picture of what is it that they really want to achieve. And then the second and the most important thing will be looking at the age of the individual. Yeah, there are certain people who may want to achieve a certain goal, but maybe age is not in their favor. So, because in order to actually achieve your goal with an IUL, we should be able to at least, I don't want to exaggerate it, but let's say put money in an IUL, fund an IUL correctly, or as designed for at least 15 to 20 years. 20 years is the best, the benchmark. If you don't fund an IUL for up to 20 years and you want to jump into distributing, you will not be able to have maximum distribution. So sometimes we can play with those numbers, and even it could overlap depending on the need or what the individual is able to put down. So, but then there are people who will have money who are able to do it right there. So you can structure it to be overfunded, which is a topic that we're going to go there, right? According to what I heard Jen, right? But if somebody is able to pay it off in 5 years, 7 years, we just make sure that we also respect it. On the agent side, you should also be mindful of respecting the MEK rule, that is not letting the plan become a modified endowment contract. A modified endowment contract is that point that would trigger a tax alert. At that point, that point in an IUL structuring, that if you step on it, is like a red line. If you cross that line, the IRS will come after this individual for whatever, whenever he gets the gain. Yeah, so you'll be taxed on the proceeds.
So it's going to lose its tax benefits once it becomes a MEK.
Yeah, when it becomes a MEK, you can lose your tax benefits. So you'll be taxed on the proceeds, that especially the interest that you make on this money, even if you don't distribute it. So every year that passes, you'll be taxed appropriately, just as if it was normal income. So, right.
So even just thinking about, let's say somebody is, let's say that they are 50 years old and they have a $300,000 mortgage that that they want to pay off sooner rather than later, right? They have a 30-year mortgage and they would like to pay it off earlier, right? Those are some of the things that they're trying to accomplish. They're in relatively good health, and they have a $300,000 mortgage that they want to pay off, 50 years old. When you hear those types of things, what are the things that you are immediately thinking about when it comes to starting to try to structure an IUL for that individual? What automatically comes to mind? Okay,
well, in cases like that, what automatically comes to my mind would be, I already know that these people have a mortgage they want to pay off. I may consider that mortgage as the initial phase amount to start with. But also, I would like to know how this individual is positioning his money. Where are the money? Where is the money going? Is he having any debt that he's paying, or does he has any chunk of money that has been saved somewhere in the bank, or other plans that we can be able to help? But then if he's able to do that conveniently without any problem, we can go on just the new money, but we could also shift the old money that has already been there to
and old money. You're talking about any extra lump sums of money that they have in savings account, anywhere,
brokerage, or any money that is maybe coming from elsewhere that may not be generating as much as an IUL would generate, or that are not as secure as an IUL. Because that's one of the selling points. You have to be able to sell the security, the point that in an IUL, your money is protected, never going to lose any money. You can only make money. And every time the market is going down, the index strategy on your account locks the gains and your principal at that point, and then you'll be able to continue just from there whenever the market is recovering. Instead of going down with the market, to be able to start coming up. When everybody's going down, you stay on top while waiting for them to maybe start recovery. At the point of recovery, you start making money on your money. So sometimes some people may have money in the market, exposed in the market, in the brokerage account, which maybe they are afraid of losing it because they have been losing it on and off. So we may want to reposition that money in it. But actually, if you want to go just on that focus on the mortgage that this individual have, well, I mean, is better. Yeah, sometimes we just ask some quick questions or some key questions that will help the individual to understand where you're going to. You can choose to have a mortgage protection policy that you pay minimum inside, and then at the end of it, it could either be a cashback option that you get back maybe your money, maybe 75% of your money, or you're not going to get anything at the end of that term. Well, if it is a term that you want to use for this mortgage, making the individual to understand that at the term of this policy, you will be left with that coverage is also very important. And also, where most of my IUL that I structure at 30 years, should I already triple or almost get into to quadruple the money that you put in. So will you rather want to get just your money back, or you want to get 3 times, or if possible, if the market performs well, even 4 times on your investment, on your every dollar that you put in?
Okay.
Obviously, so everybody will want to go for 4 times. So now, yeah.
So some important things. Number one, when we're talking about trying to structure an IUL, you want to know specifically what other debts that they might have. You want to know where do they have money, particularly if applicable, any lump sums of money, so that we can talk about being able to structure the IUL, in any number of ways. And if that's, and how quickly that they're looking to pay off their loan, like what the time frame is that they would like to be able to pay off their loan, and any other goals that they might have. Those are at least a few of the things that you are looking at specifically when it comes to asking questions to at least start structuring an IUL. Is that right?
Yes. After building that value, yeah, I'm trying to make sure I build value by comparing the IUL to other investment strategy that is been using. When you build enough value, then you'll be able to now look at the point. If you want to pay that mortgage quickly, mathematically, where do you think you want to actually pay it if you were to pay at the rate or at the pace that you're going? You write, I'll note it down. Now, when I'm structuring my IUL, I'm making sure that the plan I'm putting in place should at least defeat the previous goal, should at least be more, that it should help this individual to realize this goal, like maybe 20 years down the road or 25 years down the road. So, and if you can realize this goal without using your own money alone, but also using interest that have accrued on your money, would you like to consider that, or you want to just use your hard-earned money to pay it? So
right.
most people would say, hey,
who's going to say no?
yeah. So I mean, nobody wants to you want to labor alone, or you want somebody to help you, give you, contribute into paying this up, so that it will become really. And after this plan is established, you will discover that it's going to be easier for you to realize that, because you're not only saving that money to pay that, but you're saving it towards an insurance policy that is going to be permanent with you up to the age of 121. So even at the point where you're paying the mortgage, you're not going to be left without coverage. The coverage is not ending. You're not taking your debt benefit to pay it. We want to make sure we build enough cash within that policy that could pay off that mortgage at the appointed time. And then you continue to enjoy the benefit, the compounding effects of interest.
Okay. All right. So making sure that there's a significant amount of value built, so that, of course, when you get to the point of structuring the IUL, there's really no objection as to why they wouldn't want to do it, because it's much easier to use what it is that the bank, or I'm sorry, what it is that the interest is going to accrue, and how compounding interest is going to affect them, than to simply use their own money and then, of course, not have anything left over if they were just to do a typical term policy that ends in 30 years or 20 years or what have you. Okay, so next important thing, so we kind of touched on it a little bit, overfunding an IUL. So when you're talking about overfunding an IUL, what are you thinking about? Why does it make a difference?
Well, it's the simple difference that it makes is that Jen, would you like to have a car that can go at 80 miles per hour and you use it to drive at 20 miles per hour?
Absolutely not.
You'll be underutilizing it, right?
Right.
So it is just as important as that. I usually sometimes just say, but okay, wait a minute. This is your plan. You can get this with as minimum, as little as this, if you want just the insurance component of it. But my primary goal of introducing this to you was because I wanted you to get some value out of it. So if you will work as if you want to overfund it according to the 7702 Internal Revenue Code rule, I'm going to guide you to make sure you get maximum benefit out of that. It's just about putting your money in upfront and getting more money. And sometimes when you want to overfund an IUL, if you look critically, you end up maybe getting some couple of dollars, depending on, let's say like a third or even half of the money that you will have paid off that plan if you pay slowly. So for those who have the liquidity, who are able to do it, it's a no-brainer. I remember when we were doing one plan, Jen, you were there with one of our clients. When I brought up that portion, there was just nothing else in their mind. They wanted to go for that option. Yeah, so because nobody, when you do the math, when you do the math, you would rather want to pay off to put some money, because that's I make them to understand that this is not only going to be your insurance policy, but it is your saving account. It's your investment account. It's your insurance policy. So it has all these three components joined together. Either you put your money in your IUL or you put it in a bank and get nothing on that is going to add that is, I mean, look, the interest crediting is just day and night. So Jen, would you like to have 7%, which is what we are illustrating now, 7.1% on your money, or you want to maybe keep some of that money where you're not going to make any money out of it, and even when you want to take that money, every other factors like the inflation adjustment and also on taxes will be taken off your money. So obviously nobody wants to do that. So when they understand the need of doing this upfront, you as the agent, you're there to guide them to make sure that they don't break the law.
Right. Okay. Now with that, I know that we don't have like tons of time, but would you be able to show them, like if you want to share your screen, to be able to show people like what a $300,000 policy would look like if somebody were to overfund it with, you know, a lump sum of money in the beginning, as opposed to just the regular monthly payments?
Which one do you want us to go with? F&G, North America, Trans America?
Let's do F&G, since everybody's heard so much. Okay. Everybody's heard so much about it.
All right.
With one of the clients that that we did, because that client was able to overfund their policy and have that lump sum upfront. Didn't it allow their policy to gain value by, I don't even remember at this point how much it was, but the difference was just night and day. You know, obviously being able to have coverage in general and have an IUL, and the benefits of an IUL are already awesome, but to be able to overfund it and see the differences that it makes is, pretty incredible.
Age of the individual you want us to work with, and who do you want to be the sample client, Jen?
Oh yeah, that's fine.
And okay, what is the age?
I'm 30.
Okay, and tell me a little bit about what is it that you want to achieve financially?
Okay, my mortgage is $300,000, and I just took out a 30-year loan. Financially, like in general, of course, the sooner that I can pay off that loan, the better. Sooner that I can pay off that loan, the better, because of course, I'm saving on interest, right? But big thing for me is being able to retire by 50 would be awesome. you know, because you just hear all this stuff like retirement age is just getting older and older and older and older, you know,
Okay.
so.
Okay, well, I know there may be new agents on board here who are just maybe having their F&G writing number who have not done anything yet. So let me just start from this part. Normally, when you get your writing number and you are ready to go, you input it, lock in, and then you find yourself at this spot. All right. Are you able to see my screen?
Yes.
Is it visible enough?
Yep. Mm-hmm.
All right, okay. This is the screen I was talking about. As a new agent, just got your writing number, you want to know how to play with the system, you find yourself here when you first log into F&G portal. And that is the illustration software. You can toggle here on your new business, on commission, you can do every other thing, but let's focus on, let's go straight to the illustration since we don't have a ton of time left. Yeah. And then we'll be able to go with our client, Jen, 30-year-old, has a 300,000 mortgage. You want to pay it off. Jen, do you want to pay off this mortgage as early as maybe 20 or 30 years?
Yeah, as early as I can, but you know, 20 years would be awesome.
So I'm going to work with you to make sure that we achieve that goal together. As a financial advisor or financial assistant here, we will make sure we work together to determine what is it that if we put in this, and we'll be able to build enough value. And now, just to make sure that it is clear, just what we already spoke, Jen, tell me a little bit about what you do for a living.
So for a living, I do people's taxes. I'm an accountant.
Okay, you are an accountant, tax accountant, and after taxes, what is it that take home? What is your take home income?
Each month?
Yeah, from all sources combined.
Each month it's about 6,000 after taxes.
Okay, and after you pay all your bills, utility and everything, what is it that you're able to put aside or you've been putting aside up to now? Do you have a saving plan that you've been doing, or?
What it is that I have set aside after all of my bills are paid, probably about $1,000.
Okay, so can you say that you can comfortably put $1,000 aside every month?
Yeah, comfortably. Mm-hmm.
Okay, so we want us to work on this 1,000. Is that correct?
Well, since that's what I'm putting in as far as my savings plan, I would say, you know, if this is, are we looking at this as something where I can, you know, maybe also have something towards retirement? Because I don't want to use my entire, you know, monthly savings towards this. So maybe I can cut that down to, I can say I can put $700 a month towards this.
Okay, how is retirement important to you?
I mean, it's incredibly important. I'd like to retire by 50 if possible.
Oh, good. And have you been doing something already towards your retirement?
Well, the accounting firm that I'm with, you know, they match 401k. So, and I left another one. So I have like I have this IRA, like a brokerage account. It's just kind of sitting there. It's not, you know, it's doing okay. But yeah, I have a retirement, you know, 401k through the firm that I'm with now.
Okay, so how much money will you say you have in that the other account that you left that you think you can move towards this plan so that we can help you achieve this goal without using your money?
Well, it's not that much. It's I think there's like 12,000 in there in that account that's kind of just sitting there. Okay,
and you can shift this money into this account. If I
could if it makes sense. I'd have to see what the numbers look like.
Okay, cool. What we're going to do is that we're going to shift those your money and the new savings that you will be putting into this account, and the money you'll be contributing in this account, you'll be able to take money at some point But that money you're taking is not your money. You're taking money against, you'll be taking out money against your account value, against the money that you already built in this account. So it's like using your money and still making interest, investing your money in the market and still using that money. Does that make sense to you?
Yeah.
Yeah. So let's go. Let's get started here on the new case. Start a new case. F&G portal with there, and then we input clients information. Okay. For the purpose of training, Gen O, and then 30 years old, female, and you live in Virginia. Is that correct?
Yep.
Right. Now, type of product. When we click here, it's going to give us a drop down, Index Universal Life, and what is it that we want to use? The path setter, of course, which is the one that builds. If you are interested in cash accumulation, you want to consider the path setter, not the Everlast. The Everlast is more of a coverage based policy. So this, we get into the path setter right away. And you did said you could put aside 1,000 and you have some money somewhere. So if we can either let the system help us, or you take it off from the system and do it yourself. For the purpose of training and because of time, let's go with the system. Let the system help us. It said it was a 30-year mortgage. So she'll be paying the premium up to, we put in just that she could pay the premium up to 30 or even up to 20. I used to try to do some mathematics upfront, which we may not have the time to do it today. We'll maybe try to look for what a term policy will cost this individual. And then I look at various options. If you can qualify for a cashback option, I would just like to even say, yes, let's say you were to get 100% your cashback. And then play with the same figure. Say, okay, what if we were to add just a little bit into this and have something that belongs to us forever? And most often, some people would be like, oh, I don't have money. Then how do we overcome this objection? I usually ask this typical question. Jen, you are protecting a house here, right?
Yes.
Mortgage. What led you to buy a house? Why did you buy it?
I really got tired of throwing my money away, renting. And I figured I could put that money towards a, property that I would actually own.
Okay. Are you paying less than you were paying when you were renting in this property, or you paying more towards for mortgage monthly?
My monthly mortgage is actually less than I was paying towards towards my rent.
Wow. Then that should be really very good for you. All right. Yeah. Now, if you could, you want to pay towards your own. So that is a good point. Okay, now, a term policy compared to an IUL is going to be like renting a house and owning a house. A term policy, you renting it, you paying that money that towards something that you may end up getting just your money back if you qualify for the cashback option that most people that have been selling for so much, or it's just like you're throwing that money, or you giving that money to somebody. So if you are interested in owning a house, you also want to own your own life or your own plan, your own policy that you will never go away with you, right?
That makes sense. Yes.
Yeah. So that's just the same thing that we want to do here. So it may be a little bit expensive, a little bit more expensive upfront, but in the whole, if you look at it in the whole, it's going to be cheaper, because if you consider that, okay, if you were to take this term today, it expires at maybe when you are 60, you need to go for another term, and then maybe you may not have cashback option at that time, and that term may expire when you are about maybe 80, because at that time they could give you like maybe a 20-year term. They will not give you 30-year again. At that 80, you will still need insurance again down the road if you've not passed away, if you're still here with us. So you end up paying more, just like you would have paid if you were renting from one house to another. But now when you pay towards your house, at some point you're going to pay off that house, and then you just be staying in the house for nothing, right?
And I guess, you know, I would have to, because like my health matters, I'd have to requalify if, you know, if that was even possible.
Those are even some of the things that I don't want to scare you. But if you are lucky to even requalify after 60 years, we are not very sure that after 80 or at the age of 80, you'll be able to qualify again for another plan. And most people really know the need of life insurance when they are towards maybe after 60. Or when they are maybe after 50. So, but especially most of the clients that we get who are unable to qualify are between 70 going down the road, because most carriers will not want to do business with you. So understanding that you're going to do a little bit more here, and understanding the disadvantages of going for term after term, and seeing that at the end of it, everything, that term is going to cost you more. So what we're going to do here, Jen did say she could pay this thing monthly up to 1,000. So let me go. Okay, we put in the premium. We're solving for the face, because we don't want this plan to become a modified endowment contract. So we put 1,000 here, and let's say, well, without maybe making it look like too much for Jen, I will not go for 30, because if you go for 30, it will be like you're just doing the same thing that a term policy would have done for her. So let's see if we can end at the age of 25 and still be able to do something for her. All right. Now we did went for 30, let's say 25. It's 25 years down the road. And I usually like to put this distribution up to even 35, because some people may think that, oh, maybe it's not able to go around. So just put it to 35. You could put it halfway and let the plan breathe a little bit. We want to get maximum amount of money go towards building cash here. That's why we're using the recent provisions.
IRS rules.
77, the RRC 7702, which gives individuals who are considering IUL to be able to put more money in their IUL than they could put without breaking the 7-pay rule. So, right. So let's do it. Let's see how much we're going to get here. And okay, now, all right. Jen did tell, she told me she had some money somewhere. Okay, you said you have some money somewhere, some 12,000 sitting somewhere that you can take it in here, right?
Yep.
Yeah, I could do this, but I would not like to do this. So instead of doing this, I could decide to do it for the first, do some sort of variable options for paying the premium, so that the plan, it doesn't stress the plan. But let's see if we could do that, and then okay, let's see if that will not force our plan to be too much money. Okay, that we're going. All right, now I'm going to go with all of this. We're not considering it again because we already took it. The system is helping us to calculate this. But then she's still young. We want to go for increasing that benefit option. Pay attention to that. And since she really wants to achieve this goal early, but let me just say, okay, she's still young. She could see that policy change at age of 65. And then I normally could take 50-50 for Barclay, the index crediting, but let's go for 100% Barclay. 100% Barclay has proven to always beat whatever combination that you do with the 2 or the 3. The S&P 500 has a cap, Barclay has no cap, and it has a 1% bonus with a 145% participation rate. What this means is that if Barclay were to go up, for instance, let's say 15%, the real index in the market. So those people who are trading in the market, if they are using Barclay Trailblazer Index, which is a very solid index crediting strategy, to trade, they're going to get like 15% of their money if they were to trade, if they are trading directly. But those who has F&G pass that is attached to Barclays will make more money than those that are trading in the market and exposed to the risk of losing, in the sense that because of the 145% participation rate. So if it goes up by 15 plus that 1% bonus, you add 15 plus 1, and then you multiply it by 1.45. You will see that they will make like 26.8, I mean 22.68 approximately. So if Barclays were to go up by just 15, you make 26%, 26, almost 27% of your on your money. So this is something that many people want to consider, especially those who are against the fact that why is it that most index are being cut. So just trying to build up this, explaining this as I go along, so that you should understand that even if you were to go to the market, this is the same thing you do. But here, the company is helping you to do the work for you. And then you getting nothing, that you're not exposed, you don't have any risk of losing money. So Jen, if you were to qualify for this plan, let's see what it can do for you. These are just numbers we're running here. It's not a promise, it's nothing. There's no contract already between me and you on this. I just want to show you how the figures can help, how your money can work for you and help you pay off that mortgage without actually stressing yourself. But not only pay off that mortgage at the same time, but also building towards your retirement and also building towards an everlasting life insurance for you, because you live it until you die. So doing one thing one time, or you want to do it over and over and end up spending more money. So, I mean, nobody wants to do that. You want to lock in your age now when you are still young, or you want to live up to a certain age where you still have to do this because at one point you will need it. All right, so here's what we're able to come back with. It looks like it's just perfect. So we are a little bit above your mortgage, 365. That makes sense a little bit. Does that make sense for you?
Yeah.
Okay, so what with your $1,000 that you put into this plan and what you promised that you have that 12,000 shifting it in, this company is promising, F&G is promising that they will, if today you were to be approved for this policy, and anything were to happen the next minute, they will give you above that 65,000 above your mortgage, so you can pay off your mortgage with just maybe 1,000 that you've contributed.
Okay.
So now, but if nothing were to happen to you, let's see how this can help you down the road. We're going to focus on the most important aspect, most important parts of the plans that I usually try to go with. Sometimes this thing is just a little bit slow, but then we'll get there. Yeah. Okay. There are certain parts that you may want to review it with your client so that you can actually understand what is it that we're doing here. To secure this, like you said, you promise you want to put in that much, 1,000 every month, but there is something we call the minimum non-lapse premium, which is the minimum amount of money that you can put into this, and that it can take you up to a certain age. So let's look at that. What is that? So that you should not be scared. You see, this can end up costing you just less than $100. You see that? The minimum non-lapse premium is $99, 99.25, just less than $100 to keep this plan and be able to have a mortgage cover.
And I would get to keep that until, it looks like it's saying that if I have that until I'm 45.
Yeah, okay. Until you are 45. If the worst were to happen to you, at that point, you can chip in a little bit more than that just to make sure you continue to keep that plan.
Okay.
Because some people are like, okay, what if I don't pay, if I'm not able to pay it? So even if you were to get that term policy, you'll be paying something, maybe something around it in that. Maybe even if it's less than that, it will not be less than really something much. So if during those days that you don't have money, if you don't have 1,000, you can put as little as this just to make sure you keep this plan.
Okay, understood.
Right. So it takes away that fear that people say, hey, with index investor life, if you don't pay that money, you will suck everything and then your plan can go off, or it can become very expensive during the years that you're not making money. But how many years can you stay without the market going up consecutively on a row? So it's usually a period of months, or some few days, maybe a few months, and then it goes up, goes back up. Yeah. So after looking at that, we choose option B, which is increasing, and it's going to change to A, which is level at the age of 65. Let's see if we make that goal. This plan also comes with living benefits, which is important to know. So it comes with our loan protection, with accelerated benefit for critical illness. You can accelerate up to the coverage that you have. You can get up to 100% of your initial coverage or your coverage if anything were to happen to you down the road. Anything that qualifies as critical illness by a doctor, like say heart attack, a stroke,
cancer, accident. That type of stuff.
Serious accident. They'll be able to give you that money that they promise to give you. If you pass away, you have that money while you're alive, so you can take care of yourself and get healed. So if your face amount is greater than $1 million, you'll be able to have up to $1 million, and then you can still get to keep your plan. Yeah, and take the remaining benefits when you pass away. So now, accelerated benefit for terminal illness, the same. If you're diagnosed with terminal illness that maybe is expected that you could pass away, that maybe you have less than 18 months to live, you qualify to get the death benefit while you're alive in order to take care of yourself. You can seek some form of alternative medicine and other form of treatment. And then,
and so just to point that out. So one of the topics that we wanted to make sure that we covered, key things that we always explain to the client. So we're explaining to them, what the face amount is going to look like based on what it is, the numbers that we've calculated thus far. We want them to understand that there is a minimum no lapse fee. So I'm sorry, a minimum no lapse premium. So meaning that they're based on the numbers that we have, calculated thus far. If, let's say, times get really, really hard, or something bad happens, whatever, and they can't afford to pay that $1,000 a month, as long as they pay, let's round up $100 a month, this policy is guaranteed not to lapse at least for the next 15 years. Okay, yes. So it's making sure that they understand that. And then, of course, the riders that are available with every carrier and every product are going to be pretty different. So whatever it is that those riders are, those are, more often than not, just free riders that are just come attached with the policy. So really important that they understand all of the value that they're getting with this policy. So whatever riders come with the policy, make sure that those are explained. Don't have to go into all the nitty-gritty detail, but that they understand that there are additional living benefits. So not even just a death benefit, not even all the other money stuff that we're talking about, but things that go above and beyond just a regular death benefit term policy that's not going to have some of these different things. The living benefits that they're going to be able to have and to use while this policy is in effect. So all important things to make sure that we're all covering when it comes to talking about their IUL, if available.
Okay, you already summarized this. Thank you very much for that. And then also you talk about the chronic illness already, which is what most people always get. We know that statistically speaking, most American, more than 60% of Americans below the age of 65 will suffer from at least one or more forms of chronic illness. So at least even if you don't qualify for the other ones, you qualify for this. We're not even hoping that you qualify for those ones, because there's enough value to get out of this policy, even if those bad things were not to happen to you. Fair enough. Right. Yeah. So I don't want to always focus on that. I tell you that, hey, we're not praying that anything like this will happen. Just looking at this policy, you'll see that you have enough value from it, even if nothing were to happen to you. Remember, you said you wanted to pay your mortgage early. We're just achieving that goal. We're scaling it up from 30 years mortgage to almost maybe 15 to 18 years. So how about that, Jen? So even at the age of, look at it, at this point, if you were to just stay without taking anything out of this money, out of this account, let's not say we go in before that age of 18. Let's say just do it at the age of 20. Yeah,
years.
20 years down the road, that's at the age of 50, that's 20 years down the road. 20 years down the road, you will be able to see what you have here. You have almost $500,000 that have accumulated in this plan. So you can go in, take away 300 to pay off your mortgage. And I know that you normally you were reducing the mortgage during these years too. So we can do the math and say, okay, let's say you were paying, how much were you paying towards your mortgage? Let's just have an idea.
My mortgage payment each month, $1,500.
$1,500 and $1,500 for each month. For 1 year, you were able to pay how much?
What do you mean?
20?
1,500 times. Okay.
Yeah, we can do that. Just do the math for yourself and you see 1,500 times 12.
18,000.
So you pay 18,000 per year. So now times 20. So at this point, you must have even paid off the mortgage. So now let's look at the meeting point. So that's what is really going to sell more. Let's say, okay, if you pay 1,500, okay, 50, let's say you pay 18,000 every year. So times the first 10 years, let's say times 10, 180, okay? So we can pay off this mortgage of 30 years in 10 years. Because at this point, after 10 years, you can access at least 120,000 of this plan. Take it off. By that time you must have reduced your mortgage by 180. So you're remaining maybe like just maybe like 140,000 on your mortgage. So you take at least, let's say you take 100,000 here and they add it to that, clear off. So you'll be debt free in the first 10 years using this plan. Yeah, that's something that everybody want to hear. Say, wow, so I can pay off this house within 10 years and still be able to keep this plan. I mean, I don't know how else do we want to. Some people don't know what else you want to do, man. And then it really looks so good because you have to be able to play with those figures in order to make it make sense. Otherwise, you're just going to be like preach and then go, they'll say, I'll think about it. But when you touch really those sensitive areas, you say that, okay, this is 30-year mortgage, but you could pay it within 10 years and still be able to keep this plan.
Okay, and so I know that we're coming up on 8 o'clock here. So this, do we have the lump sum here? Like when we talk about overfunding.
Say it again.
But when we're talking about overfunding, right?
Yeah.
This, when we're doing this versus no lump sum, or when we're talking about overfunding it, what are we looking at?
We didn't even consider the lump sum here because I took it off. So if I was to put that lump sum here, it's going to have, it will have make even more effect.
Okay. Yeah. And what kind of effect would people be seeing with something like this?
Yeah, it's obviously going to be more cash upfront because it will have added to your initial premium. You will have, instead of having 12 here, you will see like 24,000 already for the first year.
Okay. Yeah, and so just again, in the interest of time. So of course, if there is more money injected upfront, that means that there's going to be interest accrued on that larger amount of money upfront. And that means that the interest is going to compound over, X period of years. So more cash is going to accumulate faster.
Of course.
It's a big deal.
Yeah. Oh, yeah. It really locked me out. So we don't want to go locking in again. That's how the system behaves most of the time. So, okay. Well, yes, it will be more money upfront. So maybe because in the interest of time, let's just try to go through this. So let's say you were able to pay your mortgage at that period, and then we leave it. I wanted to simulate it so that you see how it will really look like, so that we have the real number. So there's a possibility of doing that. Let's say at that point, 10 years, we'll go in, we'll take out 100,000, and then we'll leave the plan to continue, and then the figures will fall apart. So, but this is what you will have. This is how your money will grow if you don't take anything out of it. If you just continue to pay your 1,000 or 1,500 every month towards your mortgage, but at the end of maybe 15 years, you will have still paid off this mortgage while still keeping this, and then you have this much money. So that's an additional incentive. You want to put your money to really get all the compounding effect of interest, or you want to maybe go in, take some money from that account against your account value, paid off this so that you can free that 1,500 and you can be able to re-inject it into this plan because you're no more using that 1,500 again a year. Remember, when you take over this client, you want to be a financial advisor to this client. You really want to make sure that you're helping, you adding value, you're helping him make sense as far as his financial goals is concerned. So now you will be like, okay, so after 10 years, I could have another additional 500,000 that 1,500 I'm not using, 1,500. So I can do whatever I want to do with it, inject it here, or maybe take another. You cannot inject all here. At some point, it will reject it because it will make. So
you don't want it to make.
To take another a side plan because you can own as many of these as possible, depending on how your income, so long as your income can support it. Okay. So you going down, we can go down this illustration. 55 years, you're going to start putting money into this plan. Look how good it is. By that time, you will have put in just $300,000. And now you're having over almost $814,000 that have accumulated. That is almost 3 times your money. So now 30 years, let's say 30 years, like I told you guys, all my plans, when you design it well, 30 years down the road, you should have already triple. This is already triple. 300 times 3 is going to be 1.2. So we already have above 1.2 here in this plan at this time. Yeah. So see how your money.
And so like one thing that I always want, one thing that I always want people to be thinking about, because I know that a lot of us have come from, wherever it is that we've come from, but, for me, even though there were people who would teach about IULs and advanced market products and different things like that, we weren't really taught what the value of an IUL was. And of course, there are times for just regular term. There are times for whole life, final expense, and so on and so forth. But when you look at the numbers and even just thinking about a regular cashback policy versus an IUL, a properly structured IUL is going to crush a cashback policy any day of the week and twice on Sunday.
Anytime.
Right?
Yeah.
I mean, anytime, because because of the interest, because of how long that it can last, and because of the guarantees that are included in it. And again, I said a properly structured IUL. I'm not talking about garbage ones, but properly structured IULs will crush a return of premium policy. And again, there's a time and place for everything. But when you do it properly and it's done well, you're going to be in a position where either you're going to throw your money away or get just what it is that you've paid back, or you're going far above and beyond all of that to be able to have a plan that's going to last you a lifetime and do a lot for you. So, but I'll let you get into the retirement side of things on here, Simon.
Okay, yeah, okay. Now, like you were talking about, how can we use it for retirement? So that's it. That's the retirement portion of this. If this plan were to go like this at the age you've remember, we stopped paying money into this when you were 50. That's at the age of 20. That's 25 years down the road, right?
Mm-hmm.
Yeah, and you don't put any money like age of 55. No money is coming in. When we stop paying money into it, you'll see that the plan was actually, let me see. Okay, when we stopped paying money, the account value was at 883. Pay attention to that. And then just 10 years down the road, without any money going in, you're not doing anything any longer. You've stopped. You've built.
No more money is coming out of my pocket. 10
years down the road, you're going to see that at the age of 65, right? Because from 55 to 65, you see that we have almost $2 million already here. So that money has almost, more than double. Think about it. Look at it here. Actually, we ended at 883, and now we have 1.822 million. So, I don't know if there's any other thing where you can make money like this while you're sleeping on your bed. You don't need to be glued on your screen. You don't need to do any form of trading. You don't need to do candlestick interpretation, following stock market or crypto or whatever. You don't need to have any worries about paying Uncle Sam when you distribute this money, but yet you're making money while you sleep. So, I would like to put a little bit of part of my money. I don't want to say you put all your money here, but if I were you, I would like to invest at least a big chunk or majority of my money into this. so that it makes money for me while I'm maybe gambling with whatever I can lose. So, but because if you tell some people to stop doing trading or whatever, you'll be an enemy to them. So, but let them just experience the two and be able, at some point, they will come to a compromise. They will see that this one is better than the other one. So down the road in your retirement age, Jen, 66 years or 65, age of 65, when you retire, you'll be able to take out of this plan $208,000 every year. Do the math, divide it by 12, and you see how much you'll be able to make in your retirement without doing anything. You don't have a job. You're not going to job. You're not clocking in, clocking out. You're not driving 8 miles or how many miles or 10 miles or 20 miles, whatever. You're not using money at this time. That's the time when
$17,000.
Yeah,
$17,000 of tax-free money.
Yes, no taxes on it. That money is coming to you straight away. You can you take this to age 100. You can decide to do whatever you want to do with it. You can go into this plan early to get some money, buy some property, reinvest, inject the money into the market again and make more money off it. You don't need to just worship these millions grow. If it grows up to 1.5, you want to take 2 million, or you want to take 1 million out of it, and then maybe buy some 2 property, put them on rent, and begin to get some. That's one. Add additional streams of income to your money. Yeah, that's it. Just the effect of good planning. Remember, at this time you are not doing anything. You're not investing. You're not paying anybody to do anything for you. You don't have workers that you're paying. You are having a full-blown investment with just nobody managing it, but just depending on the company, and you can rely on them.
And I want to just touch on something, because, you know, when you think about your 401k, for like taking distributions from your 401k after, you know, once you get into retirement, right? You've worked all this time, so on and so forth, versus, or you contrast or juxtapose whatever with your IUL, right? And maybe you're also, you know, you're getting your Social Security, if Social Security is around by that time, right? The amount of money that you are, that you're getting, even just from your Social Security, is going to be taxed based on whatever your income is, right? Now, when you start taking those distributions from your 401k, you're going to be taxed on that. You got to pay taxes on that, and of course, it counts towards your your taxable income, and that can increase the taxes that you'll pay on your Social Security, which means that the money that you are supposed to be getting now, you're not even getting all of the Social Security that you could have gotten, that you've already paid for your whole life, versus taking distributions from your IUL, $208,000, $17,000 per month of tax-free money that you don't have to pay taxes on. Like nobody's coming to ask you to pay taxes on that money, and it's, you know, it doesn't count towards it. It's just your money to use however it is that you want to. So when we talk about like wealthy people staying wealthy, being able to, you know, keep as much of your money as you possibly can, like when I actually start to learn and understand how these types of things work, I mean, it's crazy to me that I got in the insurance industry, sold plenty of coverage, you know, had a lot of clients who had plenty of money to be able to work with. And I didn't understand the value of what it is that these types of things can do. So,
all right. Then, just like you were saying, for those who say, hey, my company is matching my 401k, I want to still keep it. All right, you can keep it. You would just be doing ill to yourself. If you money that's in that 401k, the government has eyes on it, they see it. So let's say you were to go to retirement with $1,800,000 like we see here. Let's just say, imagine that would have moved you from whatever tax bracket that you were to almost the highest tax bracket in this country. But if you were wise and you start maybe taking out this 401k and even paying those taxes upfront, you will go to this retirement being maybe at the minimum or the lowest tax bracket. So you don't have to even waste any other money like your Social Security and all the other money that will be coming to you. You'll be taxed depending on what tax bracket you belong to at that time. So the less you keep in that plan, the better for you, because you are trying to avoid taxes down the road during the year that you're not working.
And we know that taxes are only going to go up. They're not going down. Our taxes aren't going down.
They only go up. So Uncle Sam is not foolish to refuse to tax you on the seed of your money to make sure that when you get the harvest and you have a bountiful, maybe a big sum of money, you now comes to take that tax from it. They are not stupid. And so that's just it, like you said. This money, nobody knows. That's your private pension plan that you have now. You're taking this money, you don't pay any tax on it. You can borrow as much as you can from it, even without the plan lapsing because of the overloan protection that is on this plan. And if you pass away, the death benefit just simply covers whatever. If you have taken maybe some money that is outstanding, and then the remaining, whatever is remaining, will be given to your beneficiary for to live with. Let's say you just stop. Maybe you pass away at 80. Because if you go to the 100, they'll say, oh, I will not live up to that. At 80, how will it look like if you invest $300,000 to get 3 million? That is, your every dollar has been times 10, 10x, right? Every dollar that you put in. And then yet you still got some money sitting in here, almost $1 million that you could still take. So it's a no-brainer, man. And so if there are any questions, let's quickly rush over it. I know that usually we do more than this, but for time, we may not be able to go through because usually some will bring up curious questions and want to say, okay, is that guarantee? You were showing the non-guaranteed portion. Frequently asked questions. Just go down, scroll down, show them the historical performance of these indices, explain and be more value again upfront. Let them understand that these people, Barclays, if you even want to know a little bit about how Barclays, this Trailblazer index work, they invest in one of the lowest risk stocks. They do the same thing that you do in the stock market. So when you hear people say it's better to buy term and invest the different, where are you going to invest? Where will you invest if your investment will not still be tied to the performance of the market? And how do you know? How are you going to calculate the risk, balance the risk and the gain on that investment? These people, they are specialized in doing this. They want to take it off from you and help you do it while you relax. So do you really want to begin to stress to trade yourself when you have very little or no knowledge, or you want experts who are legally licensed to do this, not just any expert anywhere? Financial institutions that have been around for years, that are having partnership with banks like the Barclays banks, they hired, like you can also want to bring up this for those people who know a little bit about stock market, who want to maybe throw you under maybe throw some rocks at you. Okay, you know a little bit about this guy, the Blackstone and BlackRock. You know about those multi-billion companies. You know how efficient they have been over the years. These are our active partners, and they are the people that manage the general account of F&G. So think about it. We're not just doing business because someone will say, what is it here that what proof that I'm not going to lose my money? You're not going to lose your money, obviously, because you're trading with reliable partners, with people who have been in the market, who have proven their worth.
Right. And the policy in and of itself have the guarantees, the watermarks.
Yeah. And
when you're
a contract. Yeah. So
they can't.
If they breach it, they're going to be penalized. If you breach it, you're not going to be penalized. It's a legal contract that is only one side, that is binding on one side. So, I mean, you have no obligation to continue to keep it, but they have the obligation to honor what they promised they were going to do to you.
Right. And we're talking about A-rated companies. We're not talking about like people
we're not talking about billions. We're not talking about those whatever network marketing stuff that's coming up everywhere. So you may want to go down very quick before maybe we'll go into.
Okay, so anybody who has any questions, you want to either put it in the chat or just unmute and ask your questions.
There's a lot about IUL that we cannot just explain it on one sitting. So, but just to be on the safe side, this is what I usually do. Run down to this portion of it. If they ask you a question that, hey, what is showing that is not guaranteed there. So what is the guarantee on this date? The first guarantee is that this is a legal contract that is binding. These people have to honor the contract at any time. If you imagine that at the time you want to maybe rupture this contract, or you want to maybe surrender this policy, the market will be at really negative, where you'll still be netting at least 0.25% on your money. So you're never going to lose any money. At least that portion shows you that your money, your principal, and whatever gains that you have had before those years, never going to go away. Yeah, for any reason. Now we can come here and just rush through the index crediting. Look at the Barclays, the performance of Barclays index. Look at the S&P 500 index, how it's been performing for years, and then the last 10 years, the last 20 years. Barclays index have been around for about 15 years, not 20. So we will have the performance for the past 15 years, and you can see how this index, the index have been that performed on average 6.05%. For the past 15 years, on average, when they say with the ups and the down of the market, you put it all together, 6.5%. That's the average index crediting on this account. But now, people that have F&G past data, they on average, they have made 10.62%, superior to what people who just go wide to trade using the index without being under this coverage.
Jen, I have a question.
Yes.
Well, and Elijah raised his hand. Elijah, what's your question?
Okay, so you guys can hear me?
Yes, Elijah, we can hear you.
Okay, so so sorry for noise in the background, but I heard you say just something about like their premium, say it was like $1,000 a month, but one time they had to pay 100 because times were tough. I came in kind of late on that. I was coming off of, I got interrupted with a phone call. So
Elijah, we can hardly hear you.
So sorry. So I was coming in late, and I came in when you guys said, and I just had a question about, like you said, there's a clause in the policy where if they're paying $1,000 a month and say times got hard and they only needed to pay like 100 or 150, the policy will still be fully in place. Is that
at least the next 15 years?
Yes, you'll be able to keep the insurance benefits of the policy and still make minimal gain over time. And then you can keep it up to that minimum non-lapse premium applies from that time that we started this policy up to maybe for age 45. That's in the next 15 years. So you will need to up the game a little bit there, but not up to 1,000. You can decide to just increase it to 200 or whatever. If you agree, if things really get bad on you, you want to still keep it, you see that it's still going to be cheaper than a term, because down the road you paid it, you'll still be paying very little money inside. But I don't always advise people to do that, because if you do that, without being careful, at some point you can maybe the policy can lapse. Yeah, so you have to make sure you follow the advice of your financial professional. But according to the policy, that's what is recommended. That's what is in the law. That's the legal that you legally. That's what you pay that much. You can keep it up to that time. Then you will need to up again.
I got a question.
Okay, that answers my question. Thanks, guys.
All right. Who has a question?
This is Ali.
Okay.
Bobby?
Ali.
Ali.
Okay.
Jen, this question is for you. You were at the DFL in Dallas. So how is this different from the DFL par whole life policy?
So when I think about, marrying the terms, the IULs, like all the other products that we sell with debt-free life, when I'm looking at debt-free life and all that stuff, I'm looking at that as a long-term strategy to be able to pay off all my debts, not just my home, everything, right? When I'm looking at something like this, of course, like the way that things are different is that we're talking about something, again, that's going to pay off all of our debts versus, and in a specified time frame, like no questions asked, versus this is, when I think about it, this is a in the meantime, type of thing. And that can also be used as another financial product, right? So it's an in the meantime, like if I think about the one example that we went over, right? The face amount was only like 150,000. We could add a term and do all that other stuff in there, but like the face amount was 150K because we were doing the lump sum, so on and so forth. Whereas something like this, we are looking to make sure that at least with the face amount of the policy is going to be, it's going to be able to act like our short-term mortgage protection policy, at the very least. But these are the same same types of things, but it's a participating whole life policy that's designed to pay everything off, all of our debts, not just one.
Okay, Jen, let me come in a little bit.
Sure.
Let's say you had debt. What debt do you really think you have that you could not? Because remember, most of the I'm not against debt-free life. I'm just trying to say, okay, well, if you want to really understand the difference between debt-free life and IUL, debt-free life is a banking alternative, while an IUL is an investment alternative. So do you make money more in your investment or in your banking?
Investments.
Investment based.
So that answer, if that answer your question, let me go into a little bit to clarify some things. Most of the cases of the premium for debt-free life, you will see premium like 4,000, 3,000. Imagine you were to put 3,000 every month into this policy. Whatever debt you have, I can work on this. I have a way of manipulating this in a way that that debt can be paid off even earlier than you would have maybe think of paying it off with a debt-free life. The difference is that debt-free life is a whole life participative, whole life policy that's credited at less than 4 now. So most of them, maybe 3.5%, and they give you dividends. Dividends are not guaranteed. So if anybody tells you that, oh, we are saying this is specific guarantee, when you listen to debt-free presentation, they are still explaining the non-guarantee portion of it. They're focusing on the non-guarantee portion of it. They're not focusing on the guarantee. If you go with the guarantee and you go with this one, basing on those historical value that we review, at least you guarantee that even if the market were to go worse, and even if you were to have 6%, yeah, or go down to 5%, which I don't see it even coming in the next 10 years. So will you not still be able to be above that, above whatever you would have made in the other plan, if you pay the same amount of money? If I structure a debt, and IUL paying in 4,000 for 20 years, my goodness. Let's say I will even end it at 10 years. 10 years, you finish, you're done, and then you'll be able to pay whatever debt that you have down the road without having to go into any other additional debt.
It makes sense. So, Simon, in your opinion, this is a better investment vehicle than a DFL, a par whole life, because it accumulates more, and they're both good option for someone who's looking to do something with his money.
They are both good options. Yeah, like I said, don't get me wrong. Somebody who wants something like today, put money and get it today. Well, why would you want to put your money and get up to just that money that same day? I don't even see how it makes sense. Why would if you put one, I say, because they say, it's for people who want money the same year. Because as early as the second year in an IUL, you can start taking money out of this. Let's say your debt were 10,000. As early as the second year here, you can get 10,000 every year from this policy to do whatever you want to do there. We have to illustrate it and see where it can end. Yeah.
Got you.
Yeah. And so the account value is 21,000 the second year here. You've put in just 12,000. So you can be able to take money out of this. And then just going down the road there are two things different. People who want something now, which I don't understand how it makes sense to want to put in your money and get back the same money. And along the road, debt-free life, from my understanding, at some point is going to end, right?
No, it's in place.
Yeah,
it's in place until you're 121.
Okay, well, and then but you have to continue to put money in. Do you stop at some point?
Yeah, you stop eventually.
Yeah, even if you are to stop at some point, like I said, it is a banking alternative. This is an investment alternative. You're just looking at the cash, just looking at the debt benefit or the living benefit portion of this. It's far more over. If you put 1,000 in debt free, maybe the debt benefit is going to be less than 50,000.
That's fine.
50,000. Yeah, but putting 1,000 here, you having a living benefit of almost 400,000. And you still accumulating cash at the rate of 7.16%. So it will all depend on what you want to do, guys. I'm not against it. Yeah,
and I think that really what is really important when we're talking about debt-free life is one of the things that we talked about was like the mindset around it, right? Being able to use inefficient dollars and so on and so forth. That when we're talking about like paying for a policy and you hear these enormous premiums that people are going to keep paying, right? It's all about getting their mind to understand why it makes sense for them to do that, because it's a debt-free life type of, it's a debt-free life plan. Like they're not necessarily thinking about it like an insurance plan, because again, if we were talking about using, putting $8,000 or however many thousands of dollars into an insurance plan, like these people, they would be like, who are you talking to? Like, what do you mean by that? And the amount of, the amount of money that you'd be able to, like, it's insane. But to me, it's all about like the mindset, the software, being able to use all of those different things, snowball, avalanche, so on and so forth, to be able to make it happen and to help people understand how they're going to use that money to pay it off, as opposed to, if you are talented enough and the person has enough funds and enough money to be able to, redirect all of those inefficient dollars, those overpayments towards something like this, of course, right? Yeah. But to be able to get them to get on page with that, to be able to do that, very, I think it's very different. But I know we only have a little bit more time.
Jen, there's one advantage of IUL that people seem to underlook and they don't even say it, they maybe say it enough. Do you know that with the IUL, if you happen to maybe next year or the next year, you don't have money to put 1,000 here and you put in just that your $99 into it. And let's say 2 years down the road, you maybe win a lottery or you get a very good job, you get money, you have the chance to still come back and put up that money to pay for the money that you were not able to do here and still be able to get the same effect.
Oh, wow.
So they give you the opportunity. Yeah, you can go as far back as 3 years down the road that you can pay what you didn't pay, since you didn't pay up to the target or up to the required premium, just making sure that you doesn't get into a modified endowment plan. You still have the chance to do that. The flexibility around IUL is really incredible for me, but I don't know. But I listened to somebody say with IUL, we talk in terms of percentages. Guys, am I showing percentages here or we showing dollars? We're showing figures. It's not, I don't know why they say they talk in terms of percentage and there they talk in terms of dollars. All the illustration, I see the dollars here. I don't see any percentage anywhere. The only percentage is the index crediting, which is used to determine how much dollars you get every year or at any time in time.
Yeah, that's fine. Do we have a sandbox with FNG so we can go in and just play with it?
Oh, yeah, absolutely.
Numbers? Okay.
Yeah. When you have your number, you can play with this and try to understand it and also get expert advice or listen to recording like this one. We're going to make it available and you guys, people could be able to also record and listen to it.
Yes.
And if you run into any problem anytime, contact your upline. If they're not able to answer, we are always here to answer questions and help people to define the plan.
Absolutely. Thank you so much. Appreciate it.
Yeah.
I have a question.
Yeah, yes, I was just going to say, I only want to take questions for a few more minutes because Simon, I know you still have appointments and people that you have to get back to. So yeah, go ahead.
Yes. So at what point, Simon and Jen, can you borrow against your surrender value?
As early as the second year.
Oh, okay.
Because your crediting happens after 1 year. Remember, we choose the Barclay annual point to point. It's not 2 years, annual point to point. So after every year, they will credit. So as early as the second year, so long as there is money in your account or your surrender value column, so long as you build some cash value, you can borrow as early as the second year, depending on how the plan is structured. Somebody may be very interested in having a big debt benefit, and they may structure a plan where you have like 2 or 3 zeros here. So depending on how it is being structured, you can be able to take money as early as the second year.
Okay, and so it's like to pay back. Do you have to pay back in full? So
you don't have any obligation to pay back, but if you choose to pay back, you'll be doing more good to yourself by doing so, because you're just paying back so that you continue to enjoy the compounding effect of the interest down the road.
Oh, okay, but it seems like there are times when you borrow against your surrender value, it's like you have to pay back, like at, let's say, for example, 5% or 6%. So what's that for? So because it's your money, and just like you said, you can pay back if you want to, but why there is that 5 or 6%, like the borrowing, like values like
the loan rate.
Okay.
The
yeah,
5%
yeah,
rate?
it's more like loan rate. Yeah, that type
Listen.
of thing.
Okay. Is it Edo?
Yes, that's me.
Okay. If you, okay, let's say, like I have a typical example I used to run into, but I don't want to go into that. Let's say you were to borrow just as it is now. And then let's say the market was performing just as it is, current assumption of 7.16, and you were to pay 5% interest on your money. And then your money is still there because you're borrowing against your account value, working money for you at the interest rate of 7.16. Are you gaining money or you losing money? You pay 5% interest and then you get 7.16 credited into your account.
Yeah, it's
That's
like
the money that you are using because you're using that money to do some stuff. And so you can still make money on that money where maybe you took it to go and invest in to do maybe some small investment, buy something and sell. You make some little interest there and you're still getting 2% interest. That way you get the difference between 7 and 5%.
Yeah, it's like you are gaining.
Good. So does that make sense?
Yes, it does. It's just I didn't understand if you were obliged,
because you
like,
didn't take
to
out
pay,
your money,
to
because
pay
some
back
people
or
will throw
not
you
pay
under
back.
the listen, because if somebody will ask you that, you take, why is it that you're being taxed on your money, you're being given interest on your money? You didn't take out your money, you borrow against your money. So that's why even if you go, it's like a collateral. Your account value is acting as a collateral security for your money, for you to be there to give you that money. So if you borrow against your account value is still there working money at a higher interest crediting. So you're netting 2%. Is that still bad? You're using your money, but you're still making 2% on that money?
Yeah, no, that makes sense. Yeah, it's like 2%.
So that's how you can explain to people who ask you some of those type of questions, which I know they will always come.
Of course.
Yeah.
And Simon, it's 8:30 now, so I want to stop it here.